Hello and welcome to Investment Insight. Before we begin, make sure to subscribe and hit the like button. Now let's break down what's happening in the markets today in a clear and simple way. Today we are looking at how Vladimir Putin flew to Beijing recently, expecting to secure this multi-billion-dollar economic lifeline.
Right, the big May 2026 visit.
Yeah, exactly. But instead of getting that lifeline, he basically came back as the world's most heavily armed discount supplier.
It's really a massive structural shift in the global economy. I mean, looking at recent analysis, the data paints a picture of a transformation that is just happening incredibly fast.
Yeah.
We're watching Russia become deeply, almost fundamentally dependent on China.
And based on the research, this isn't just some abstract political story you scroll past on the news.
No, not at all.
This is a tectonic economic shift. It's altering energy markets, military production, and, well, the very plumbing of the global payment system.
Exactly.
Okay, let's unpack this for you listening. Imagine a former high school star quarterback who lost his starting spot.
Right.
And now he has to carry the water cooler for the new star player just to stay on the team. That's essentially the dynamic here.
That is a great way to put it.
And as an American investor, someone trying to make sense of the world while navigating your 401k,
Yeah.
you really need to understand how this machinery actually works.
Because it impacts you directly.
Right. Especially with the current U.S. administration under President Trump taking a very firm stance on global trade and alliances. When two of the world's largest economies lock into this kind of asymmetric embrace, the ripple effects hit everything. I mean, from inflation at your local grocery store to the hidden risks inside your retirement portfolio.
So we really need to look past the political theater here. We have to examine the actual mechanics of what is keeping the Russian economy afloat right now.
Yeah.
And maybe more importantly, what exact price they're paying for that survival.
So let's start with that Beijing visit in May of 2026.
Okay.
The photos were, all smiles, handshakes,
Yeah.
a unified front against Western foreign policy.
Classic diplomatic photo ops.
Yeah, they praised their unprecedented relationship. But the economic reality tells a much darker story for Moscow.
It really does.
Because, looking at the data, Russia completely failed to secure the one thing they desperately needed from that trip, which was the final agreement for the Power of Siberia 2 gas pipeline.
Right. They reached this vague understanding, but the actual core terms were left completely unresolved.
Like the price of the gas.
Exactly. The price, the construction schedule, the volume flexibility, all of it just up in the air.
And that omission is pretty glaring. Right?
No, it's huge.
Yeah.
The Power of Siberia 2 is this proposed pipeline designed to send 50 billion cubic meters of gas every single year.
Wow.
Yeah, from Russia's Yamal region down through Mongolia and into China.
And those Yamal gas fields, they were historically built to feed Europe, right?
Precisely. But after losing that massive, lucrative European market, Russia faces this immense geographic and infrastructural crisis. They literally have to redirect that supply east.
Wait, if Russia's selling 35% more oil to China in early 2026, aren't they making a ton of money? Why does this one gas pipeline matter so much?
What's fascinating here is the difference between the two markets. The physical mechanics of selling oil versus selling natural gas are, well, they're entirely different.
Okay, how so?
And that difference dictates geopolitical power. So think of oil like a Wi-Fi connection and natural gas like a wired fiber optic cable.
Oh, I like that.
Right. Oil is relatively liquid, both literally and economically. You can just pump it onto a massive tanker ship and sail it to India, China, or South America.
You can reroute it on the open ocean if you need to.
Exactly. It's mobile. The infrastructure moves with the product.
Right.
Natural gas, however, requires massive fixed infrastructure. To move gas across oceans, you have to build liquefaction plants.
And those are expensive.
Multi-billion-dollar, highly complex refrigeration factories. They chill the gas to minus 260 degrees Fahrenheit, turning it into a liquid so it fits on specialized ships.
And Russia just doesn't have enough of those plants.
No, they don't. And they can't easily get the Western technology to build more. So their only other option is the fiber optic cable approach.
Physically digging up the earth.
Right, laying a massive steel pipeline thousands of miles across a continent.
And once you build a pipeline, you are physically tethered to the customer at the other end. You can't just unplug it and sell it to someone else.
You are entirely captive.
Yeah.
And China knows the grocery store is stuck in one place.
Yeah, they have all the leverage.
Beijing is in absolutely no rush to sign the Power of Siberia 2 deal because Well, they already have the first Power of Siberia pipeline delivering 38 billion cubic meters a year.
Oh, wow.
Plus, they import liquefied natural gas from the Middle East. They have pipelines running in from Central Asia, and they are massively expanding their own domestic renewable energy grid.
So China has a highly diversified portfolio of energy options, and Russia just has a stranded asset.
Exactly. China is taking Russia's infrastructural desperation and turning it into extreme pricing power.
Based on recent analysis of that May visit, the two nations signed over 40 cooperation documents. They boasted about their trade volume hitting $228.1 billion in 2025.
Right.
But Beijing deliberately withheld the massive long-term cash flow guarantee that Russia actually needed.
Because Russia isn't an equal partner here.
Yeah.
They are a captive vendor forced to accept whatever wholesale price Beijing dictates.
Which creates a really fascinating vulnerability. If Russia is taking massive discounts on its primary export energy, they have less capital to sustain their domestic economy.
And, crucially, their military-industrial complex.
Right. So if they are bleeding leverage in the energy market, how are they possibly affording to sustain their industrial output?
It's a great question.
Because my immediate thought is, they must be cutting corners elsewhere or leaning on someone else for the actual hardware.
They are leaning on China for the hardware, and the depth of that reliance is probably the most critical vulnerability in their entire economy right now.
Let's look at the data on that.
Yeah, according to recent data, Russia's reliance on China for high-priority military technology, so semiconductors, telecommunications equipment, advanced electronics, it's skyrocketed.
By how much?
From 32% in 2021 to a staggering 89% by 2023.
Oh, wow. And looking at more recent numbers, like a May 2026 report, it notes that over 90% of sanctioned military technology is now sourced through China.
It's unbelievable.
But it isn't just microchips and drone batteries, right?
No.
Because other analysis highlights something much more foundational. In 2023, almost 90% of the machine tools Russia imported came from China.
Right. And machine tools are the machines that build the machines.
We aren't talking about hammers and wrenches here.
Exactly. We are talking about 5-axis computer numerical control, or CNC machines.
Okay, for the beginner listener, what are those?
These are highly advanced robotic systems. They carve solid blocks of titanium into jet engine turbines or mill steel into artillery barrels with, microscopic precision.
Here's where it gets really interesting. It's like trying to build an advanced smartphone, but you are forced to buy every single microchip, screen, and screw from your biggest competitor's store because no one else will sell to you.
That's exactly it. And if we connect this to the bigger picture, it really comes down to metallurgy and software constraints.
Okay.
German and Japanese manufacturing equipment is widely considered the gold standard globally.
Right. Russia used to buy from them.
Yes. The physical drill bits wear down slower, the software calibration is tighter, and the ambient temperature sensors are just more accurate.
So what about the Chinese machine tools?
They are functional, but they often lack that bleeding-edge precision. And when you are machining a missile guidance system or an aerospace engine, a defect the width of a human hair doesn't just mean the product looks bad.
It means the engine runs too hot and catastrophically fails in midair.
Exactly.
So by losing access to high-end Western equipment, Russia is basically forcing its entire defense and industrial base to build its next generation of hardware on slightly shakier, less precise foundations.
And that severely stunts Russia's long-term industrial modernization. But, the even bigger issue is the total loss of strategic autonomy.
Right.
If you're a manufacturer, you want multiple vendors bidding for your business. Russia has one vendor.
Just China.
Just China. If Beijing decides tomorrow to slow down the supply of these CNC machines, restrict access to certain software updates, or suddenly jack up the prices, Russia's military-industrial base faces immediate paralysis.
They have no alternative supplier to call.
No.
That raises a massive mechanical question, though.
Yeah.
If Russia is buying 90% of their tech and machinery from China, how are they actually paying for all this? Because, they are largely cut off from U.S. dollars and Western banks.
To understand this, we have to look at the plumbing of global finance. We have to define the SWIFT system.
Right, SWIFT.
SWIFT isn't a vault holding money. It is essentially a highly secure messaging app like WhatsApp for global banks.
So if a bank in Tokyo wants to send $10 million to a bank in London, they use SWIFT to securely message the authorization.
Precisely. And the West essentially banned major Russian banks from using that messaging app.
Right. And without SWIFT, Conducting international trade in U.S. dollars becomes incredibly slow, expensive, and legally perilous.
Exactly. Consequently, since 2023, China's purchases of Russian oil, coal, and metals have largely shifted away from the US dollar and into the Chinese yuan.
Oh, no.
Russian businesses and banks are now deeply embedded in the Chinese financial system just to clear their daily trades.
So what does this all mean? We hear the term de-dollarization thrown around a lot in the news, making it sound like Russia's becoming financially independent. But is that actually true?
This raises an important question. The mainstream headlines often miss the vital nuance here. Russia is not achieving financial independence at all.
They're just switching cages.
Exactly. They are merely trading their historical reliance on the US dollar for a new, total reliance on the Chinese yuan.
Wow.
In the short term, sure, pricing their oil in yuan helps them bypass Western sanctions and keeps the lights on. But long term, it drags them entirely into Beijing's monetary sphere.
Let's unpack the mechanics of that trap.
Right.
If Russia sells oil to China and gets paid in yuan, what can they actually do with that currency?
That's the kicker. They can essentially only use it to buy things from China.
Because the yuan isn't a freely convertible currency on the open global market like the dollar or the euro.
Right. Beijing strictly controls its exchange rate and how much capital can leave its borders.
Right.
So Russia accumulates billions in yuan from selling oil, and they are practically forced to recycle that exact same currency right back into Chinese tech, Chinese cars, and Chinese machine tools.
It's a closed loop.
Exactly. For the global economy, this specific version of de-dollarization doesn't mean the US dollar is collapsing. The dollar remains the dominant global reserve currency by a massive margin.
Right.
What it actually means is that heavily sanctioned nations are walling themselves off and forming a yuan-dependent bloc.
Okay, let's bring this home for the American investor listening right now.
Good idea.
You might be just starting out, looking at your retirement app, trying to figure out how this geopolitical maneuvering translates into actionable insights for your own portfolio.
Right.
We've established that the clear, undisputed winner in this dynamic is China. Let's look at the specific benefits Beijing is extracting.
The benefits for China are immense. First off, they secure incredibly cheap energy. Because Russia is a captive discount supplier, China lowers its baseline manufacturing costs.
And cheaper power for Chinese factories makes Chinese exports way more competitive globally.
Exactly.
The second benefit is all about geography and logistics, right?
Yes, they secure land-based energy routes. If China relies heavily on oil from the Middle East, that oil has to travel on massive tanker ships across the ocean.
And squeeze through the Strait of Malacca.
Right, a very narrow waterway near Singapore. That strait is a massive maritime choke point.
Right.
In the event of a global conflict or a naval blockade, whoever controls the Strait of Malacca can essentially starve China of its energy supply.
But a massive steel pipeline running from Russia directly over the land border into northern China.
That is practically immune to a naval blockade. It radically alters China's national security profile.
Wow.
And thirdly, China gets a strategic buffer. Russia absorbs a tremendous amount of Western diplomatic, economic, and military attention.
Which frees up China to maneuver in its own region with way less scrutiny.
Precisely.
For you, the everyday investor, you obviously can't invest directly in Russian assets right now.
Right.
Sanctions and massive legal risks make that literally impossible.
Definitely do not try that.
Right. So how do you play this? Where does a massive geopolitical shift like this hide in a standard investment portfolio?
You really have to look for the secondary exposures, and I'd suggest starting with the risks.
Okay.
We need to talk about the geopolitical discount and how it might already be sitting inside your 401k. Think about those Chinese machine tools and electronics we discussed earlier.
Yeah?
Many of those are what the industry calls dual-use technologies.
Let's define that for the listener. A dual-use technology is something like an advanced drone battery, a specific grade of chemical, or a microchip.
Exactly.
A Chinese company might manufacture it, intending it to be used in a commercial agricultural drone, or maybe an electric car. But that exact same component can easily be diverted to power a military surveillance drone or a missile guidance system.
Precisely. And based on recent analysis showing Chinese companies providing this dual-use tech to Russia, those specific Chinese manufacturers face a very real risk of sudden Western sanctions.
Secondary sanctions.
Right. The U.S. government can say, if you sell to the Russian military, you are cut off from the American financial system.
And here's where it hits you, the listener. If you open your retirement account and you hold an emerging markets exchange traded fund or a broad international growth mutual fund, You likely own pieces of these massive Chinese industrial and tech giants.
You probably do.
You might think you are safely diversified. But if those companies get hit with sudden secondary sanctions, American investors are often forced to divest, or the market panics, and the stock plummets overnight.
It's true.
You carry a hidden geopolitical risk simply by holding the index.
The market will suddenly devalue those Chinese industrial stocks if the threat of secondary sanctions becomes too high. You really need to look under the hood of your international funds and understand your exposure to Chinese manufacturing.
So what about the other side of the coin? Where does this fractured global economy create long-term value or opportunity?
The primary opportunity lies in the ripple effects of this new block building. As the global economy fractures into a U.S.-centric sphere and a heavily sanctioned China-centric sphere, it supports robust long-term demand for gold and strategic commodities.
Because historically, gold acts as a geopolitical hedge.
Exactly. When nations are locked out of the SWIFT system and cannot transact in dollars, they inevitably turn to gold as a neutral physical store of wealth to settle debts or back their own currencies.
Which provides a solid fundamental floor for the price of gold over the long haul.
Furthermore, investors should look closely at the European defense and energy security sectors.
Oh, that's interesting.
Yeah, for decades, Europe relied on cheap Russian gas and maintained relatively modest defense budgets. Now, with Russia entirely focused eastward and leaning on China's massive industrial base to sustain its military production, the math in Europe has fundamentally changed.
Right.
The European Union has realized it must completely rebuild its own sovereign defense manufacturing and secure totally independent energy grids.
Because if Russia is leaning on the largest manufacturing base in the world, Europe has to build its own walls.
They have to.
So you were looking at European aerospace companies, defense contractors, and firms building non-Russian liquefied natural gas infrastructure and renewable energy grids.
Yes.
These sectors stand to see sustained massive government investment over the next decade.
It is a profound reminder that in global economics, every action forces a reaction. A stalled pipeline negotiation in a Beijing conference room directly influences the defense spending passed in Berlin,
Wow.
which in turn alters the valuation of industrial stocks in Shanghai, and eventually the international mutual funds sitting in an American worker's retirement account.
It connects everything. It's not just geopolitical theory.
Yeah.
It is the actual physical rewiring of how the world manufactures, transports, and pays for things.
And that rewiring brings us to a scenario that investors really need to chew on.
Okay, let's hear it.
We've mapped out how this current setup heavily benefits Beijing. They get the cheap energy, the secure land routes, and the geopolitical buffer.
Right.
But what happens to the global economy if China eventually decides that Russia's weak negotiating position is no longer worth the risk of Western sanctions?
Oh, wow. That is a terrifying thought.
Yeah.
What if the cost of doing business with a sanctioned Russia finally outweighs the benefit of the discounted oil?
Right. If China decides to protect its vital access to Western consumer markets by suddenly complying with secondary sanctions and literally turning off the tech and financial tap to Moscow,
The ripple effects would be unprecedented.
absolutely unprecedented. We would be looking at an almost immediate collapse of Russia's industrial output, massive chaotic shocks to global energy and commodity markets, and a total repricing of global risk.
Then,
Beijing holds all the cards. It is the ultimate sword of Damocles hanging over this entire partnership.
yeah, the guy carrying the water cooler only stays on the team as long as the star player finds him useful.
Exactly.
If that dynamic snaps, the entire global market changes overnight. Well, we will definitely keep tracking these data flows as the situation evolves. Thank you all for joining us on this deep dive into the shifting global economy. Don't forget to subscribe and hit that like button.